if we look at, say, the first half of this year, European gas demand was around 13% lower than the same period over the previous year. If we compare it to the, say, average of the previous 3 years, gas demand was around 17% below the 3-year average. With regards to how much of this was divided between industrial and residential demands, not all European countries offer data which presents this neat split between industrial and residential demands, but some that do give us a clue to the overall trend within the European market. So let's take the UK, for example. For the first half of the year, industrial demand was around 16% lower year on year. That's 16, sorry. Whereas residential demand was 6% lower. And if we were to say to look at Italy, the industrial demand, the drop across the first half of this year compared to last year was around 12%. But residential demand, the drop was closer to 15%. What is clear is that the high gas prices over the last 2 years have created quite a difficult environment for the industrial sector to work in. Of course, European gas prices have weakened throughout the first part of the year, but current price levels are something like 3 times higher than the average of the previous 3 years. And as a result, demand destruction has taken place. By that, I mean, industry has been cut back or cut altogether. And of course, projected fuel costs still remain high when looking into the rest of the year and going into next year. In fact, just last week, CF Fertilizers in the UK announced that it was considering closing one of its ammonia plants because of the projected high fuel costs within the United Kingdom for the foreseeable future. In fact, they said it would be cheaper to import ammonia from other parts of the state operations. I'm thinking of sort of the US with regards to that.